Hello, everyone, and welcome to the Final Bar. It's Thursday, August 29th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action, but especially today, because I have to tell you, this is the final episode of the Final Bar, the final bar, as it were. It is a bittersweet moment to announce that to all of you. It has been a fantastic run. We launched this show about 5 years ago when I joined Stockcharts here in Redmond. It has been an amazing run. I want to thank so much Sky Boggs, our head producer, Tatiana Avery, Denvy Wright, and many others that worked on the show through the course of the last 5 years. All of our wonderful guests, some of the great conversations that we've had. It's been a pleasure using this as a platform to navigate these markets along with you. I do want to let you know two things to keep in mind as we wrap the Final Bar. Number one, we're going to continue to create great content here on our YouTube channel. I will probably be creating a different type of show that we'll have here on YouTube. We'll continue to write on our blogs here on Stockcharts.com. So you won't lose me altogether, just in a certainly in a different format. The other thing that would help me a great deal, please go to my YouTube channel, which is called Market Misbehavior with David Keller, CMT. We'll put a link in the description below. If you could head over there and subscribe to me there, that would be great. I look forward to adding some additional content for sure. And there will be a lot to think about here in the coming weeks and months with the next Fed meeting, with the seasonal tendencies, with a very common fourth quarter rally. We've got a lot to talk about here, not just today's market activity. So please keep following us here on Stock Charts, on our website, on the Stock Charts TV YouTube channel. I will still be on here in some form, and especially if you could go to my channel called Market Misbehavior, and I'll look forward to continuing this discussion over there for sure for many moons to come. With that in mind, let's get to our final market recap. And look at what happened today. Quite a bit of movement today in the averages. You can see, of course, NVIDIA by the end of the day sort of dragged things down. The narrative earlier in the day for the S&P 500 was things are great, no real issue, right? NVIDIA misses earnings, NVIDIA's down, but everything else is just kind of fine. The Dow, in fact, made a new closing high today, closing up about 0.6% to 41,335. So sort of the non-growthy stuff kind of doing just fine. And there is some growth, to be honest with you, in the Dow, but it's much more of a mixed and more value-oriented benchmark than the S&P 500 and the NASDAQ. The S&P literally almost perfectly flat from yesterday's close. Now, it was up about 56.40 earlier in the afternoon, but by the end of the day, that afternoon sell-off pushed us right back to yesterday's close. We finished just below 55.92, and that's just a hair's breadth away from where we finished the session on Wednesday. Mid caps and small caps both up as well. The S&P 600 was up 0.5% today. The VIX moving slightly lower, right? So VIX is down about 1.4 VIX points to 15.7, we'll call it. So VIX remains sort of in that pullback, but not that painful of a range between 15 and 20. Now, the whole shifting of the VIX here in the last month or two, I think, is a key story we will continue to follow in our work for sure as we navigate these markets here, because this has traditionally been a good measure of volatility. I would say at times the market has felt way more volatile than the VIX would imply. At times the VIX spikes and it feels crazy unrealistic. Maybe the VIX is meaning different things than it used to. I will certainly look forward to trying to figure that out with you as we go forward. Interesting movement in the fixed income markets, and one headline that was sort of, I think, pushed aside by the Dow making a new high, by NVIDIA selling off after earnings, is the fact that the yield curve is almost slightly not so inverted anymore. We're going to look at the shape of the yield curve when we look at interest rates here in a moment. The general rate environment moved higher today with the 10-year point moving up the most. But overall, we're starting to see the 2-year point almost being level with the 10-year point, which it's not been that way for quite some time. And I have the chart to show you that performance over the time. Bond prices moving lower today, about 1/3%. The dollar index moving up by about 1/3%. Gold and silver. I had some questions on silver after yesterday's show. I talk about gold, and to be honest with you, it's probably I don't know what the word would be, some sort of behavioral bias. I own gold in a number of accounts, so I watch it very, very closely. So I'm always paying attention to the price of gold. I don't own silver or silver-related assets directly, so I don't pay as much attention to silver prices. That's probably a better reason than any I could make up for you. So for what it's worth, I tend to think of them as very similar. I just think of the precious metals trade and think of it as gold and silver, and maybe to a lesser degree like platinum, palladium, other sorts of things. But gold and silver both moving higher today. The GLD up about 0.5%, silver up about 0.4%. Besides copper prices slightly lower, everything else up. Crude oil prices actually had a decent day today, and that is propelling the energy sector to be, I believe, the top performer today. Cryptocurrencies actually looked quite strong earlier in the day here. Bitcoin actually briefly broke above 61,000. Here as we're recording the show after the U.S. equity market close, we're back below 60,000, so that 60K level very much still in play here. Bitcoin currently trading around 59,500. I'm skeptical about upside in Bitcoin until we can sort of resolve a move out of this basing pattern. Bitcoin has been range bound for about the last 6 months. I get excited when a chart like that changes, and while I do own Bitcoin and GBTC as a Bitcoin play, I'd feel much more comfortable about that in a shorter term account if we start to break out and start to follow through on some of these short term upswings. I would argue still at best it's consolidating. Looking at the 11 S&P sectors, we might take a moment in a bit to look more at sectors in a bit more detail. You can see energy number one. That's with crude oil prices popping today. The XLE was up about 1.25%. Financials number two up 0.9%. Industrials number three up 0.7%. 4 of the 11 S&P sectors finished in the red. Technology down 0.9%. Consumer staples down 0.5%. Real estate down 0.4%. So certainly a bit of a mixed results here. As we've seen, I think that's been sort of a common theme here. Looking at the Magnificent Seven names, you can see NVIDIA, earlier in the day, it wasn't as bad. It was down about 2 to 3%. And it felt for a while that the market was just going to ignore that negative, that miss and just sort of focus on broader strength. And while certain things certainly finished just fine today, NVIDIA finished down over 6%. And the kicker is it's such a big weight, obviously one of the biggest market caps in the world. And as a result, when a stock like that is down over 6%, that's going to start to hurt. And that rotated lower aggressively in the afternoon, which is what really drew the S&P and certainly the NASDAQ 100 deeper and deeper off of their highs during the day. All right, let's look at the daily chart of the S&P 500 and check in on how things are playing out here. I wrote an article for CNBC Pro, so if you follow me over there, you might have seen some conversation on this earlier in the day. But, we've talked on this show about just pullbacks in the last 12 months. What has been the sign that pullback is resolved in a bullish way. And that's what we saw in May, June of this year. That's what we saw in November and December of last year. Basically, that recovery after that, 4 to 8 week pullback, we started to see some improvement and we broke above trendline resistance. We broke above moving average resistance. But then we made a new high on strong momentum. And that is one thing that we definitely saw in December of last year, that we definitely saw in May of this year, which we definitely have not seen so far here in late 2024 here, certainly in August 2024. The S&P has stalled out at an attempt to retest the new highs, and the momentum is just in a much weaker position. So when a market tests resistance on weaker momentum, or even worse, when it breaks out on weaker momentum, that's when I start to get concerned, because that's a bearish momentum divergence. Price and momentum disagreeing. Momentum is usually a better gauge of the underlying strength in the market, because that's really looking at the dynamics of the price movements, not just what the price levels are, but how it's actually getting from point A to point B. That's what RSI is really measuring, is the sort of day-to-day movements and how that relates to the general structure on the particular price chart. So the fact that we're trying to break out here for the last 2 weeks almost, with the RSI languishing around 60 instead of breaking to new highs with the RSI above 70, that would be the bullish outcome. I'm not seeing that yet, and that's not to say that next week we couldn't just completely resolve that after the Labor Day weekend. But I'm not seeing it for now, and I think that's something to pay attention to. Breadth conditions, I would say no real change here. We don't have the McClellan Oscillator updated for today's trading just yet. I'd be very curious to see, given the rotation lower that we had going into the close, it looked pretty clear that we would not break below the zero level here on the McClellan Oscillator. I would say that looks less obvious at the close because so many things rotated lower with NVIDIA really dragging things down. If the McClellan Oscillator goes below zero, it's not the end of the world. And I would say the way that you recognize that is by looking at the cumulative advanced decline lines, right? This tracks the general trend in stocks closing up or down on the day, and you can see that the New York Stock Exchange, the S&P 500, and indeed all of these, are really at or near new all-time highs just in the last week. So overall, the trend in breadth has been pretty strong, where you often get an early sign that things might not be as constructive as you think is when the McClellan Oscillator goes below zero. And it's not the end of the world, right? I mean, last couple times, August, we sold off for just a bit, but then obviously recovered off the low. Late May, we went below zero, and the market pulled back for about a week before just continuing that uptrend with the Mag 7 names sort of reinvigorating the market. But again, it's one of those things that I look for. A break below zero would just tell me, okay, let's reassess and see if that short-term weakening in the pace of breadth is a warning sign of deeper things to come. It's just to focus on key support levels and making sure that we hold in a position of strength. So for now, holding okay. I would check that as we process the closing data here at Stockcharts and see if that's still the case going into tomorrow's session. Now, interest rates, we've talked about often, of course, on the show. The general trend in rates going lower has been something we've widely covered off of the April market low. Rates have come down from a 10-year around 4.7% down to a 10-year around 3.9%, which is where we're at the end of today's trading. But what I want to show you here, which we don't highlight this a lot, but this bottom series is basically just looking at the daily difference between the 10-year yield and the 2-year yield. It's 2s minus 10s, or in this case, 10-year yield minus 2-year yield. And 2s versus 10s is basically a way of showing the shape of the yield curve, right? The 2-year point versus the 10-year point, which is higher and by how much. The 10-year point has been lower than the 2-year point because we have that inverted yield curve, and that traditionally, certain in the last couple decades, has been a pretty good predictor of recessionary periods. Inverted yield curves have usually signaled cautious tone by investors that usually means things are slowing down and a recession is imminent, if not happening already. Now, the yield curve has been inverted for over 2 years now, actually. It's going back to 2021-22 when we became inverted. It's actually very, very close to getting above that zero level. In early August, it very narrowly avoided going to a no longer an inverted reading, just using this particular comparison of 2-year yields minus 10-year yield minus 2-year yields. Keep an eye on this one because a normalization of the yield curve could imply a normalization of economic conditions, or certainly the expectations for economic conditions could play into a Fed lowering rates 50 basis points here in the next couple weeks, and could be the sign of a broader economic recovery, or certainly the trend leaning that way. So keep an eye on this particular chart. It's part of my Mindful Investor Live chart list. If you're not familiar, some really key macro charts to pay attention to. All right, to continue on here, I want to show you the 11 S&P sectors. And again, we used to show this on this show quite often. I got away from it. I don't really remember why. I don't know if that was an explicit decision. Just sort of ended up going in other places. But I'm using the CandleGlance view here just to show all 12 of these charts on the same page. We have the 11 S&P sectors and then the S&P 500 itself in the bottom right. And my question to think about as you're looking at these 12 charts and just looking at what's similar and what's different, which of these sectors are above two upward sloping moving averages, which is one of my basic assessments of a strong uptrend, right? Price, an upward sloping 50-day, an upward sloping 200-day. If you have that configuration, conditions are pretty good, right? Could be some noise in the short term, but overall things are just fine. So sectors that fit that criteria as of today's close: communication services, consumer discretionary, barely staying so, staples, certainly, financials, healthcare, energy just barely with today's rally leading the 11 sectors higher, back above an upward sloping 50-day. Industrials, yes. Materials, yes. Technology, no. It broke below its 50-day here. Utilities, yes. Real estate, yes. So 10 out of the 11 S&P sectors, technology is the only one that is not above two upward sloping moving averages as of Thursday's close. I think that means something. Think of that as like a sector breadth reading. Most sectors are sort of in that good trend sort of characteristic. Now, how many of them have made a new 52-week high in August? This is where that list gets a lot lower. Communication services, not really. I would argue this is still testing resistance more than anything. Discretionary, definitely not. Consumer staples, yes. Financials, yes. Healthcare, yes. Energy, no. Industrials, yes. Materials, just barely here in the last couple of weeks. Yes. Technology, no. Utilities, yes. Real estate, yes. That means 7 out of the 11 sectors have made a new 52-week high here in August. The 4 that have not: communication services, consumer discretionary, technology, and energy. So to be clear, the 3 FANG sectors plus energy, which weaker oil prices have sort of plagued the energy sector here over the last 6 months. I think those 2 things that I just told you about, in terms of most sectors in a primary uptrend as defined by the slope of their moving averages, that tells you that generally things are pretty good right now from a trend following perspective. The fact that 4 really key sectors, really 3 key sectors plus energy, 3 key growth sectors, are not making new highs here in August tells you all you need to know about leadership. The leadership is not in growth. The leadership is not in semiconductors. NVIDIA's earnings today, I think, is just the latest bullet point confirming that. I think it behooves investors to look outside of those growth sectors and look for better opportunities in other places. Just to put a bit of a finer point on that, I created this chart earlier that I wanted to share with you. This is looking at the returns, the percent returns of different ETFs from the July market peak, right? So the S&P peaked out like the second week in July 15th or 16th, came down into an August low, and now, of course, the S&P is all but recovered back to that previous peak. So the S&P 500 from the July peak to where it's at right now, it's currently finished today around 1.2% below that July peak. The NASDAQ 100 is about 5.2% below that day, and the Magnificent 7 ETF, MAGS, is down over 8%. The equal-weighted S&P, the ticker RSP, is an equal-weighted ETF, tracking the S&P 500 names, but equally weighting the 500 stocks, is up 1.6%. So the S&P is down 1.2%. Equal-weighted S&P is up 1.6% over that same period. But look at what beats all of those things that I just said. Gold, GLD, is up over 2%. So it's interesting, again, when you think about this market and you think about the Dow making new all-time highs and you think about what that means for optimism for stocks, I don't have a problem with you being optimistic about conditions, given the fact that we're at or near new all-time highs. That's not a time when I've learned it pays to be particularly bearish. However, let's not ignore the leadership trends. It has been a very different market after that July peak. Into the June-July period, it was the growthy stuff getting it done. Now it's been everything else. And it's not just been during the pullback when those things outperformed. It's been in the recovery too. And still the Magnificent 7 trending lower here in the last couple of weeks, while gold and an equal-weighted S&P are trending up. And that shows you that investors are rotating elsewhere. I would be following that trend, which I think has been clearly documented, certainly on this show. Now, as we talk about what's happening here, I do want to mention, because we'll sadly be closing the mailbag here for good, but as I look one quick glance through the mailbag to see if there are any good nuggets of a question. Someone asked about a potential head and shoulders top on the semiconductor space. And I think that's a really interesting point to make, right? I mean, is this a left shoulder, a top, and it's kind of a double head, but ignore that for a moment. The right shoulder potentially was established here with a failure to regain the 50-day moving average about a week ago. You have clear support right around $200 a share. The 200-day moving average just above there around 215. So what you have to remember is this could be a head and shoulders top. It could very well be, and it is looking very similar to other head and shoulders tops that I've certainly observed. But you have to remember, to validate, to confirm that head and shoulders top, you have to break down through the neckline. That's actually a key part of that process, which means until and unless the SMH goes below 200, completing that head and shoulders top, you really can't count it as a head and shoulder. It's a potential head and shoulders top. If you want to be, a little more, I guess maybe a different way to think about this, instead of using intraday prices like a bar or candle chart, using closing prices, that still gives you a neckline right around here with the April closing low and the August closing low. It's right around 215, right at the 200-day moving average. So as long as the semiconductor ETF SMH remains above the 200-day moving average, and I would say you cannot label that a head and shoulders top. But if and when you do, you absolutely could label it so, and I will be the first to tell you that is 100% of an accurate way to describe that. Let's talk about NVIDIA. NVIDIA obviously down over 6% today. Not a great look. And again, what concerns me about NVIDIA is not just one day. I mean, at some point you're going to have a negative earnings release in any case. But what you have to remember is that this comes after NVIDIA has stalled out around 130, and that's what it's been for the last week or two. That's after stalling out at 140 back here in mid-June, topping out at 135 in early July. Now we're topping out at 130. So those are lower highs, right? We're making lower highs and lower lows. The momentum is not particularly strong. Similar to the S&P, the RSI is not breaking above 60. So it tells you that this chart, while it's still holding up okay, it did get below the 50-day moving average today. I would say the more concern is the fact that the momentum is more consistent with bearish phases. And that is what a big stock like NVIDIA with a huge market cap, almost $3 trillion, will weigh pretty heavy on the markets if we see that rotate a little bit lower. Other charts to talk about. Alphabet's another one. In terms of the Magnificent Seven, I'd be watching 3 of these very closely. Meta, to see if and when we can finally break out of this range. It hasn't happened yet. NVIDIA, to see what happens after this earnings miss and being down 6% today. And Alphabet, can Alphabet hold its 200-day and hold the August low? If stocks like Alphabet are breaking below their 200-day and breaking below their early August low, as much as you might feel some optimism about certain types of stocks, which I would argue that that's fair, it's not the benchmarks, right? Because the benchmarks are dominated by Alphabet types of charts. So if they're looking weaker, the benchmarks are going to be weaker. I think this presents an outrageously good opportunity to outperform. And it's all about looking at defensive sectors, more value-oriented sectors like industrials and financials. There are charts that look great right about now. It's just not the stuff we're used to looking great. Now, it's not all bad. Affirm broke out over 30% today, that is, and reversing a pretty consistent downtrend. When I see a chart like Affirm that has been in a consistent downtrend of lower highs and lower lows, it's all about breaking that pattern. Just in one day, with the significance of this move, we have gapped above previous resistance. So now we're making a new swing high. I think going into tomorrow's session and then after the long holiday weekend, you get follow through, right? Do we see additional buyers that are willing to pay more than $42 for the stock, even after it's up over 30% from Wednesday's session? I think that's still an open question. But for now, I think this is a pretty impressive upside reversal for a stock that's been in a primary downtrend for quite some time. To wrap up the final version of the final bar here, I want to share with you 3 charts that for me kind of tell the story of the value of technical analysis and the types of charts that I like to identify and anticipate in my work. And again, I'd appreciate so much if you continue to follow me anywhere you can find me. And I promise I'll keep putting out great content in a number of different forms here. Polestar, PSNY, electric vehicles, certainly a compelling long-term thesis. I'm thinking of John Markman's fantastic book, Fast Forward Investing, where he talks about thematic plays like AI and electric vehicles and nanotech and things like that. The challenge is there's often a disconnect between the promise of a new technology like AI or electric vehicles and the stocks themselves, because these are companies that are actually trying to navigate these uncharted waters, pun intended. What I like about the chart of Polestar right about now is it is really just starting to emerge from a basing pattern. Now, this is a pretty low price stock, right? I mean, if it's a U.S. listing of Polestar, PSNY is the ticker. You can see lower lows June into August and higher momentum. So this is an example of a bullish momentum divergence of lower lows in price, higher lows in momentum. These are the kind of charts that I look for when things are going down. I look for momentum divergences that suggest to me, okay, maybe we are nearing the end of that bearish phase. But then I start to look for signs of accumulation. I think what's interesting about the chart of Polestar is we're just starting to break above the July peak. And so I think sustaining that, getting above the 200-day moving average, which it failed to do in July of last year, I think would be key. So this is an early developer, but something that would put it on a list of charts that I would probably certainly start to follow. If things start to work a little bit more, you get into something like a PayPal, right, which has had a divergence, but has actually started to improve quite a bit and actually stabilized a while and actually making a new swing high. MarketAxess, MKTX, as the ticker I meant to say, is another one, right? You saw the market moving lower on higher momentum here in the first and second quarters. Now we've broken higher. We broke above the previous swing high. That was the example I highlighted with Polestar, but then we followed through and broke above the 200-day moving average, improving momentum, continuing to make new highs. This is an example of a chart that I would very much start to get interested in because it's demonstrating a rotation from distribution to accumulation, where investors, where big institutions are obviously starting to accumulate accumulate shares, and that is causing the price to appreciate over time. And then ideally, we get to long-term winners like this, right? When you look at a chart like Tenet Healthcare, and people ask me, well, how did I miss this? My answer is look to the left on the chart and look for those early signs of a rotation. Look for signs that we went lower on higher momentum. Look at where we gapped out and broke above that range. Look at where we broke back above the 200-day moving average and where the momentum started to improve. Look where the relative strength really started to increase. Those things all happened at the end of last year. So if you miss this sort of move, I think you're missing catching these opportunities earlier on as they develop. I can't tell you how much. I can't tell you enough how much a platform like Stockcharts.com really helps to answer these questions. That's why we started the show, is to demonstrate the value of technical analysis and really highlight examples like we just showed you of how things rotate from bearish to bullish configurations, or to the contrary, bullish to bearish configurations. I would encourage you to spend some time on the Stockcharts platform, take on a free trial if you could, and see where it can take you. I think it's so underpriced relative to the value that you will get from the Stockcharts platform. And again, as we wrap this final episode, I want to thank you so much for tuning in. Appreciate all of your thoughtful comments and suggestions over the years. I will look forward to continuing creating new content for you in a number of different places. Keep following us here on Stockcharts TV. Please make sure you follow me over at Market Misbehavior, my other YouTube channel. And for the last time, be well, stay safe, have a great night.